So let's start by talking about, the academic paper, like that's kind of where it all begins. So what were Zhou and Zhu like really trying to figure out with this paper?
So, if you look at a lot of the existing research around stock price behavior, you'll often see things like short-term reversals, momentum, long-term reversals, all kind of looked at in isolation, right?
Yeah.
So short-term reversals suggest that after a stock has gone up for a bit, it might be due for a little bit of a pullback. Momentum says, hey, if stock has been doing well, it's probably going to continue doing well. And long-term reversals say, well, what goes up must come down eventually. So these are all these kind of different patterns that we see in markets, but they're often studied as separate things. And what Hanzu and Zhu wanted to do was say, well, can we kind of bring this all together? Can we create a single factor that captures this idea of trend across all these different time frames? And that's what they set out to do with this trend factor.
Yeah, like a unified theory of trend almost.
Yeah, exactly. And the thinking is that this factor can potentially adapt to different market regimes because it's not just focused on one specific time horizon. So it can capture those short-term bursts of momentum, but also ride those longer-term waves.